If you look at the stereotypical setup of a day trader online, it's absolute sensory overload.
Oh, completely.
You've got like 6 glowing monitors, flashing heat maps, alert sirens going off every 5 seconds. I mean, it literally looks like the control room of a nuclear submarine mid-meltdown.
Right, and that aesthetic is exactly what traps so many people. They crave that dramatic tension.
Yeah, we're culturally conditioned to think that's what active, profitable capital management looks like, right?
Yeah.
Just pure, unfiltered adrenaline.
Exactly. But when you step into the actual environment of an elite professional prop desk, like what we run at the Paradise team, it is shockingly quiet.
It really is.
It's methodical, it's calculated, and honestly, to the untrained eye, it looks incredibly boring.
Well, welcome to Bitcoin Deep Dives by MyCryptoParadise. Today, we are taking a magnifying glass to the mindset, the psychology, and the tactical playbook of our own elite Paradise team trader, Simon.
We really want to welcome you to the Paradise family with this one, because here, capital preservation is our absolute highest priority.
Always. And to do that, we're opening up our latest internal market updates to explore a pretty harsh reality. Most people who enter the crypto market, they lose their money over a 3-year cycle.
It's sad, but it's true.
And they don't lose because they can't read a chart. They lose because they're fighting their own human neurology.
Right. So we are going to look closely at the behavioral science here. Why does the short-term, lucky gambler almost always hand their capital over to the calculated, patient professional?
It requires a fundamental rewiring of how you interact with the market. I mean, here at Paradise, we aren't here for the dopamine rush. We are here to build enduring wealth.
Absolutely.
Okay, so let's unpack this because we are using real current market data today.
Mm-hmm.
We're looking at the recent price action, like the chop between $74,000 and $65,000.
But we aren't just doing a simple technical readout of those numbers.
Right. No, we are using these levels as a window into the professional trading psychology that Simon relies on every single day.
And, the starkest contrast we see internally is the timeline. Retail traders often treat this market like a literal slot machine.
Oh, yeah. Pulling the lever.
Exactly. They are completely consumed by short-term excitement and variable rewards, and the human brain is actually hardwired to seek out this exact type of unpredictable payout.
It's the B.F. Skinner box experiment.
Yes, exactly that.
Like the rat presses the lever, sometimes it gets a pellet, sometimes it gets nothing, so it just keeps frantically pressing the lever. The amateur trader wants the 100x jackpot, and they want it by Friday.
Precisely. And the danger is when an amateur takes massive, uncalculated risks, they might actually hit a winning streak.
Right. They get lucky.
They get that massive influx of dopamine. For a few months, they might even violently outperform a disciplined professional like Simon.
What?
Oh, sure. In a pure bull run, reckless leverage looks like genius. But the behavioral science dictates that the brain begins craving the roller coaster itself. The euphoric highs, and surprisingly, even the deeply agonizing lows. The drama essentially becomes the addiction.
Man. And the math always catches up, doesn't it?
Always.
Yeah.
But for the Paradise team, this isn't a hobby. It is a highly structured business. And a professional system is, by design, fundamentally boring to the human brain.
Let's use that restaurant analogy we were kicking around earlier, because I think it perfectly illustrates the difference to a business and a gamble.
The great analogy.
Think about running a high-end Michelin star restaurant versus just buying scratch-off tickets at a gas station. Running that high-end kitchen takes meticulous, repetitive, often incredibly tedious daily preparation.
Right, the unglamorous stuff.
Yeah, you are obsessing over supply chains, ingredient costs, inventory loss, exact oven temperatures, just to guarantee a 5% profit margin at the end of the year.
Exactly. Whereas buying a scratch-off ticket is just a desperate, chaotic chase for an instant payout.
Right.
The professional trader accepts that 80% of their time is going to be spent doing absolutely nothing exciting. It is pure inventory management.
Just waiting.
It's waiting. It's taking very small, calculated paper cuts or closing out break-even trades when the structure shifts. The actual highly profitable serving that incredible Michelin star meal that only represents about 20% of the process.
So the greatest traders in the world aren't the ones with the most magical proprietary indicators.
Mm-hmm.
They're the ones who have successfully conquered their own psychology.
They have trained themselves to be immune to boredom.
Which is huge.
Hey.
But I want to pivot here a bit because this emotional discipline is exactly what separates the winners from the losers when the market turns violent.
Oh, absolutely.
The amateurs, driven by that emotional dopamine cycle we just talked about, they actually serve a very specific structural purpose in the market ecosystem.
They become liquidity.
Yep.
Let's look at the anatomy of a true market bottom to really understand this. Because a macro bottom is not formed just because prices get a little cheap and retail decides to playfully buy the dip.
No, not at all.
A true bottom requires a structural bloodbath.
We are talking about total, absolute capitulation.
Yes. And it's not just the retail traders with high leverage panicking. For a true cyclical bottom to form, we have to see capitulation from long-term entrenched holders.
Which is crazy to think about.
Right. Critically, this includes Bitcoin miners and large institutions. Just look back at the historical bottoms, like 2018 and 2019 around $3,000, or that brutal winter of 2022 and 2023 around $16,000.
Oh man, the $16,000 bottom, that was rough.
During those periods, massive players were forced to dump their holdings at a significant loss.
Let's drill into the mechanics of that for a second. Why would a massive Bitcoin mining operation, which, fundamentally believes in the asset's long-term value, sell at a massive loss?
Because of external real-world pressures. During those massive drawdowns, smaller and mid-cap miners face a compounding crisis. Global energy costs skyrocket, pushing their electricity bills to totally unsustainable levels.
Right.
And at the exact same time, the price of the Bitcoin they are mining drops.
So their revenue is cut in half while their costs double.
Exactly. And on top of that, the ASIC machines they use to mine, they suddenly drop in resale value. So they are financially squeezed from 3 different directions all at once.
They're just bleeding fiat just to keep the warehouses running. They literally have no choice but to liquidate their Bitcoin reserves to avoid corporate bankruptcy.
Right. They are mathematically forced to become what we call weak hands.
Weak hands.
Yeah, in market terminology, weak hands aren't just easily frightened retail traders. They are any entity, regardless of size, that is compelled to sell under duress.
Wow.
And waiting patiently on the other side of that transaction are the strong hands.
The smart money. These are the institutional players and massive whales who have just abundant capital sitting in reserve.
Exactly.
But here is the mechanical reality we really need to explain to the listener.
Yeah.
If you are a whale with, say, $500 million to deploy, you cannot just log on to an exchange, hit market buy, and fill your bags.
Oh, if you tried that, you would experience massive slippage. There just isn't enough supply resting on the order books at your desired price.
Right.
Your own buy order would immediately spike the price thousands of dollars against you. You'd get terrible average entries.
So to fill an order that size without completely moving the market against yourself, you need a counterparty. You need a massive, concentrated wave of selling. You basically need someone willing to market sell $500 million worth of Bitcoin straight into your resting limit orders at the exact moment the price is at its lowest.
Precisely. You need mass capitulation, you need the miners to break, and you need the retail market to panic. The coins have to move from the weak hands, who are forced to sell, into the strong hands, who have their limit orders layered in deep liquidity pockets, just patiently waiting.
Okay, but I struggle with that framing a bit. Let me push back here.
Sure.
When we see this panic, it is usually accompanied by some terrifying global headline. An exchange collapsing, a major macroeconomic crisis, sudden regulatory crackdowns, you name it. Are you saying major unforeseen events don't actually move the market? Or are you saying the market structure was already fragile enough that, any bad news was going to break it?
That is the absolute perfect way to frame the question. It's the latter. The market structure dictates the vulnerability. From a purely mechanical standpoint, the market is an algorithmic engine constantly seeking liquidity. When the structure is over-leveraged and exhausted, it is primed for a collapse. The terrifying headline is merely the catalyst. It's just the pin that pops the balloon.
So the big players already see the structural exhaustion. They have their limit orders waiting down at that $16,000 bottom in 2022, and the headline is just the psychological weapon that triggers the liquidity event.
Yes.
It forces the emotional traders to finally capitulate and fill those institutional bids.
Exactly. The news generates FOMO when the market needs retail buyers at the top to act as exit liquidity for the whales. And it generates pure panic when the market needs retail sellers at the bottom to fill whale buy orders.
Wow.
This is exactly why the Paradise team philosophy is entirely focused on observing these exchanges on-chain rather than reacting to, CNBC headlines.
And how do we actually track that? Because we aren't just guessing that people are in pain. right? We are looking at specific metrics like adjusted net unrealized profit and loss or ANUPL. Let's break down how Simon actually uses that.
Yeah, ANUPL is a phenomenal on-chain metric. It effectively measures the total network's pain or greed by looking at the price every single Bitcoin last moved at compared to the current price.
Okay.
When the metric plunges into deep negative territory, it proves mathematically that the vast majority of the network is holding at a severe loss. It literally quantifies the bloodbath.
So it takes the guesswork out of it.
Exactly. Simon and the team don't guess when capitulation happens. They wait for ANUPL to prove that the weak hands have finally transferred their assets.
So knowing that the market is essentially this psychological minefield designed to algorithmically shake out emotional participants, how does a professional Paradise Team trader actually execute in the current environment?
With extreme calculated patience, it is the mindset of a sniper. Simon's current playbook is split into two distinct, highly patient scenarios, Plan A and Plan B.
Okay, let's dissect Plan A first. Right now, there is a massive structural resistance sitting at $82,000.
Right.
Plan A is waiting for a clear, undeniable five-wave bullish structure change above that specific mark. But let's clarify what that actually means on a chart for the listener. Why 82,000 and what is a five-wave structure?
Well, 82,000 is critical because breaking it invalidates the current lower high, lower low bearish sequence on the macro time frame.
It proves a regime change.
Yes. And the five-wave structure comes from Elliott wave theory. It isn't magic, it is literally the visual footprint of crowd psychology.
Right.
A five-wave motive trend represents a definitive shift from doubt to accumulation to aggressive, sustained belief by major market participants.
But the crucial part of Plan A is the requirement for confirmation. I mean, Simon isn't buying at 80,000, just crossing his fingers and hoping it breaks 82.
No, never.
He waits for the breakout. He waits for the price to retrace and test that old resistance to prove it, is now acting as new support, and only then does he execute.
Exactly. Amateurs try to front-run the breakout, and they get caught in fake-outs all the time. Professionals wait for the market to show its hand.
But relying entirely on an $82,000 breakout seems incredibly risky if, macro conditions suddenly sour.
Mm.
I have to assume Simon isn't just flying blind. If the market rejects that level, there has to be a contingency for a deeper capitulation. Which brings us to Plan B.
Right, so Plan B acknowledges the data showing we haven't seen total structural capitulation yet. If the 82,000 resistance holds and the market rejects, Plan B involves waiting for a violent drop down into a strategic reaccumulation zone.
And where is that right now?
Based on historical volume nodes and Fibonacci retracement confluence, that zone currently sits deep between $55,000 and $44,000.
Wow. Those are massive, deep liquidity pockets.
They are.
That's where the institutional limit orders are resting, just waiting for the retail panic we talked about.
Precisely. That is where the risk-to-reward ratio becomes wildly asymmetrical in our favor.
Okay, so Plan A is waiting for a confirmed, structured breakout above 82,000. Plan B is waiting for a bloodbath drop down into the $55,000 to $44,000 zone. So what is Simon doing right now while the price is just chopping around in the middle?
He is doing absolutely nothing.
Nothing. While the amateur on Twitter is frantically trying to scalp a few $100 on a random Tuesday, getting chopped to pieces by intraday volatility, the professional is literally doing nothing.
He is sitting on his hands. It goes right back to the restaurant business analogy.
Yeah.
There is a massive psychological trap right now around the $69,000 level. It's loaded with historical resistance. As the price approaches it, the news cycle will likely start pumping out bullish headlines, trying to generate that retail buy pressure.
Oh, for sure. Bitcoin to $1 million.
Exactly. And the amateur feels an overwhelming physical urge to buy right at resistance, terrified the rocket ship is leaving without them.
And they buy the exact top of a local peak, right before the smart money uses them as exit liquidity and dumps it back down.
Yep.
Simon, meanwhile, flat out refuses to be liquidity for someone else. He waits for his specific confirmations. Plan A or Plan B? There is no Plan C.
Let's bring in the other analogy from our internal sessions because it beautifully illustrates how to visualize this patience. We don't view the market as a rigid machine. We view it as a breathing organism.
I really love this concept. Think of the massive macro trends, the ones that drive the price up to entirely new cyclical highs as the inhales.
Yes.
In technical terms, these are those five-wave motive trends we discussed. They are powerful. It's the market filling its lungs. But an organism cannot inhale forever. It eventually, inevitably has to exhale.
And the exhales are the corrections, the complex, choppy downward movements that shake out the weak hands, reset the leverage, and establish a healthier structure for the next move.
You cannot force an organism to inhale before it is finished exhaling. An amateur trader is like someone holding their breath, turning blue in the face, trying to aggressively force a long trade during a massive exhale. A professional like Simon just sits back, watches the rhythm of the chest rising and falling, and breathes with the market.
And right now, the ultimate macro target we are eyeing internally is positioning for the next massive inhale that could take Bitcoin toward the $169,000 level.
169K. Wow.
But you only get to ride that inhale if you survive the current exhale.
If we connect this to the bigger picture, this breathing analogy highlights the ultimate psychological shield for a professional trader: total detachment from outcomes.
It's vital.
Amateurs constantly misuse technical indicators. They look at like MCD histograms or stochastic RSIs as if they are crystal balls meant to predict the future with absolute certainty.
And the market owes you zero certainty. Let's look at how Simon actually uses something like a MACD histogram. It stands for Moving Average Convergence Divergence. It simply measures the distance between short-term and long-term momentum. When the histogram shrinks, it doesn't magically predict a reversal. It just mathematically tells you that the current trend is losing power.
It basically tells you who is currently in control, the bulls or the bears.
Exactly. If the structure on the daily time frame remains bearish, if the market is clearly in an exhale, a professional plays with bearish trading tactics.
Right.
They don't stubbornly fight the trend, aggressively longing every dip just because they believe in Bitcoin's 10-year value. They read the momentum data, identify that bears are in control, and manage their capital accordingly until the structural regime actually changes.
It is entirely about high probability setups. They execute only when the math is in their favor, and they manage that risk strictly. And if the trade goes against them, they don't take it personally, they don't revenge trade.
Because to the professional, a loss isn't a failure. It isn't an attack on their ego or their intelligence. It is just a necessary business expense. Yeah. It's like paying for spoiled inventory at that Michelin star restaurant. It's just data.
Data used to sharpen the strategy for the next execution. And this really brings us back to the core ethos of MyCryptoParadise. As part of this family, you are absorbing a profoundly different way of moving through the financial world. Every single day, the Paradise team operates on a set of unbreakable core affirmations.
We think in probabilities, never in emotions. We accept that we cannot control the market. We can only control our response to it.
We respect risk management above absolutely everything else.
Yeah.
You have to protect your capital like it is your lifeblood, because in this business, without capital, you have no business.
We treat losses as mere feedback to refine our edge, and we view wins not as a stroke of lucky genius, but as the natural mathematical result of disciplined, repetitive execution.
You are now equipped with this elite mindset. You understand the mechanics of the trap. You know exactly how algorithmic liquidity hunting works and how the news is used as a catalyst to force weak hands to capitulate. You know that the market is a breathing organism, and that patience, that boring, meticulous inventory managing patience, is the ultimate sniper's edge.
The transition from gambler to professional is entirely within your control. It doesn't require a higher IQ. It requires higher emotional intelligence. But making that shift demands rigorous, honest self-reflection.
Which leaves us with a final thought for you to mull over. Take a hard, honest look at your own trading activity over the last 30 days. Go back and look at the exact moments you clicked buy or sell.
Really look at them.
If your strategy feels incredibly exciting, if it gets your adrenaline pumping, if you are constantly checking your phone at dinner and it keeps you awake staring at the ceiling at 3 a.m., ask yourself a serious question. Are you actually building a methodical financial business that will secure your wealth for the next decade? Or are you just paying the crypto market an incredibly expensive admission fee for your own entertainment?
A casino will always welcome a thrill seeker with open arms. But a professional prop desk demands discipline.
Choose your mindset carefully. Until next time, stay disciplined, stay patient, and welcome to Paradise.